CNBC-TV18.
That's the first tick on the index. Absolutely quiet. The Nifty is up about 18 odd points.
Benchmark indices are up close to about 0.25% as we speak.
Steady as it goes, it's up 51 points on the Nifty.
The bulk of the action happened in the first 45 minutes of trade, isn't it? Because after that, it's been, I don't want to say sideways, but it's been steady. Look at that. Almost as if 50 points has been stuck on the tape. TCS, the tech names, incremental gains from Reliance, incremental gains in ITC and names like ICICI Bank. I mean, this is the part of the market which really contributed a fair bit to the push which we saw.
Hello and welcome to CNBC TV 18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action and 5 headlines. I am Reema Tendulkar and these are the headlines for the day. The Indian indices snap a 3-day losing streak thanks to a late rally. PSU banks continue gaining momentum with the index soaring 1.5%. Infosys, Reliance, TCS bat for the bulls, while HDFC Bank, Kotak Mahindra Bank and Bharti Airtel register cuts. Shares of new age companies like Paytm and Nykaa continue to decline. Share sale by anchor investors via block deals and fears of more stake sales spook investors. Crude oil prices gain after Saudi Arabia denies rumors that the OPEC was considering an output hike. The country's energy minister says it is sticking with output cuts and not discussing a potential output increase. GAIL and GSPL gained 2% apiece after the revised gas pipeline tariff norms take effect. Experts say these companies will benefit the most from the changes. That includes scrapping of incremental tariff sharing. In stocks making headlines, Dr. Reddy's named a defendant in an antitrust complaint filed in the U.S. court. Stock ends in the green as the street had already factored in a possible litigation. Meanwhile, Keynes Tech makes a strong debut, listing with a premium of 32%. But first up, markets. A last-hour recovery on Dalal Street saw the market snap a 3-day losing streak. The Nifty and the sensex gained close to about 0.5%. The Nifty ending about that 18,200 mark. PSU banks led from the front. The PSU banking index up 1.7%. Prashant Nair gets us a wrap of the day's trading action. Prashant?
Bulk of the action coming through in 2 blocks of time today. First 45 minutes and the last 45 minutes. I mean, the last 45 minutes basically doubled the gains which the market was trading with. So we ended in a pretty decent shape and form, 90-odd points on the Nifty, which is nothing to scoff at. Where did the gains come from in this sharp last-hour rally? Infosys and TCS, Reliance pushed things up. ITC and ICICI Bank participated. Apart from IT stocks, the 2 pockets which did well, PSU banks and the metals part of the market. Actually, the only group of stocks which was down was the real estate index, which lost. Broader markets, even though the Nifty improved quite a bit, was 1:1, advances to declines. So names like Mazgaon Dock, Mytrip, PSU banks like UCO, Bank of India, etc., Mirza International, another defense name like Garden Reach, Varun Beverages, and so on and so forth. Stocks which were down, Paytm lost quite a bit. I mean, the overhang of additional shares coming to the market is there. Nykaa was down sharply. Adani Transmission, RVNL, which is a good performer recently, amongst others. I mean, I think, you know, that is the point. The broader markets are not improving, and you need that to improve for things to come back in any material way and to give comfort for the bulls. Out of the US, I mean, volumes are thin. It's a holiday shortened week there because of the Thanksgiving holiday. And I think the FOMC minutes of the last Fed meeting will also be watched out for. But we had a decent close, a clean close on the index. Let's see if we can continue this when we come back tomorrow.
Prashant, thank you very much for that. Let's get you some expert opinion now. Rahul Chadha, the Chief Investment Officer at Mirae Asset Global Investment, believes that the markets will remain range-bound for another 6 months. Listen in.
We've been cautious on markets for the last 6 to 9 months, and we continue to have that view. Look, markets are going to be range-bound at least for another 6 months. We've seen YTD. I was looking at the performances here. Look, Indian market has done its bit by falling the least amongst the regional pairs. In dollar terms, the market's down about 7% compared to, let's say, S&P, which is down 17%, HSCI, which is down 25%. So I think for next 6-9 months, we would be range bound. It's only when markets get discomfort that the Fed's moved away from peak hawkishness to neutral and is becoming more dovish. And the same thing happens with policy making in India also, that the central bank moves from raising rates to neutral to probably cutting rates. If you look at the numbers, those numbers have been phenomenal. These names have not done anything for 10 years. So there was obviously a pent-up demand for this. These names were under-owned. Thankfully, we had some of these names about 2 years back, enjoyed the rally. Last couple of months, we were a bit kind of a circumspect here, and the reason was a bit worried on the macro front. We'd seen sharp drawdown in forex reserves. Thankfully, that pattern's been corrected in recent weeks. We're seeing some bit of an increase in reserves. Again, bulk of our financials exposure would be still private banks. One would have some PSU banks, but these would be the leading PSU banks like SBI, some little exposure to Bob, etc.
Continue to like the banking space. Let's move on now to the second headline. Shares of new age companies like Paytm and Nykaa continue to decline as share sales via block deals by anchor investors and fears that there is more to come spook the markets. Paytm ends with a cut of 11.2%, while Nykaa was down 4.5%. Vivek is joining by to get us a complete, comprehensive list of the block deals which have been seen in these new age companies ever since the lock-in was lifted.
Well, that's right. So what we've done is we've analyzed the underperformance of these new age businesses given the sharp selling pressure that we have witnessed. So, let's have a look at the 4 recent listings where you've actually seen the fact that the anchor investor or the lock-in has actually expired. So first up, the one that we're looking at is Nykaa. This particular stock, despite the fact that it's not completely, given up as some of the others, this particular stock, ever since the lock-in has expired, has seen a block deal in every single session after that. The announcement of the bonus issue actually compounded the confusion in terms of how exactly the selling would materialize. And, if you're talking about some of the key sellers, every single day, we're actually seen some significant block deal happen over here. Lighthouse, at this point of time, we understand, has completely exited from their stake as far as Nykaa is concerned. TPG Growth was another significant seller from Nykaa. The other one that we are looking at this point of time is Delivery. The lock-in for this particular stock or this particular ended on November 21st. One of the major investors, Carlyle, exited half their stake. They had around 5.2% stake. They've exited 2.5% stake. So they continue to hold around 2.5% stake. And this is the fear that we are seeing most of these companies actually having at this point of time. The third name that we are looking at after Delivery is PB Fintech. When you're talking about PB Fintech, remember, this itself was a disruptor in the insurance space, but after the listing, the company also saw quite a bit of disruption happening in terms of the government coming up with new norms, especially from IRDAI. This particular stock has been an underperformer and has seen significant selling pressure, especially from Tiger Global 8 Holding that has sold a significant chunk of its holding. Lastly, coming to the biggest underperformer, we are talking about Paytm. Paytm has seen a biggest decline in terms of the selling pressure since its listing. The lock-in ended on November 15th. And when you're talking about the stock performance, it's down 75% from its IPO price. Remember, the IPO price was 2,150. Alibaba.com, was the one that continues to have a significant stake. And also, when you're talking about their stake, it's a little over 31%, both of these entities combined.
Vivek, thank you very much for that. Let's get you some opinion now on these new age tech companies. Rahul Chadha of Mirae Asset Management believes that the corrections in these stocks could provide an attractive opportunity. Listen in to what he had to tell us earlier.
Something which we've been interested, we've added, is being the food delivery space, the likes of Zomato, where we've seen the company do a lot better in last 2 years in terms of gaining market share, etc. And one got good entry points when the supply came, where the stock was nearly down 30-40% from the IPO levels. So one can be opportunistic in these good companies, make sure that one builds position according to the price one is comfortable with.
Mytrip is the other stock on our radar. It soared 19% today, and this is after being locked in an upper circuit of 20% yesterday. Mangala Malu, my colleague, is standing by with the key takeaways from the management interaction with CNBC-TV18 earlier today.
Well, Mytrip ended up in double digits in today's trading session in terms of gains, and this after a 20% up move that we saw yesterday as well. But yesterday's up move can be explained by a corporate action. The stock went X bonus and ex-split as well. And these events usually cause a flurry of activity in the stock itself. But today, the move could be perhaps attributed to what the management said to us on CNBC TV18. But more on that in just a bit. As far as this corporate action is concerned, remember the company listed in March 2021. After a year in February, they announced a 1:1 bonus. And now, within a few months after that, they've announced a 3:1 bonus and a stock split of 2:1. So that was an interesting development that we need to monitor. As far as the fundamentals are concerned, the management said to us that, in the second quarter, they grew 25% as against the industry, which actually flattened out. And that meant that they gained their market share 11 to 12% as against 8 to 9% that they had earlier of the total market. And in that, online travel agencies, their market share is upwards of 20% as well. Going forward, second quarter is a seasonally weak quarter for travel aggregators and travel operators. They believe that the second half of this year has seasonal tailwinds, so likely to do better than what the performance was in the second quarter itself. And importantly, the margin miss this time around was on account of a 13 crore one-off in their marketing expenses. Perhaps that will not be there going forward as well. And we also need to watch out for any sort of inorganic activity that the company might be up for, because they've said that, they are looking at spaces in the aggregation space for cabs, hotels, as well as buses. Let's hear out the management.
Usually there is a seasonality in travel industry, and quarter two, the quarter which passed by, is usually the weakest quarter. And if you see that, even though it's the weakest quarter, quarter one because of the summer holidays, and quarter three because of winter vacations, do much better than quarter two. However, at Mytrip, since we are a growing company, we actually grew our total business by more than 20% in this quarter, while our competitors saw their growth to be either flattish or slightly degrown as well. So as we are picking up the market share, the company grew. We certainly believe quarter three and quarter four should be better than quarter two.
That's the company Mytrip guiding that the second half is actually going to be better than the Q2 quarter that we've had. Let's move on now to the third headline. Crude prices gained after Saudi Arabia denied rumors that the OPEC was considering an output hike. The country's energy minister says it is sticking with output cuts and is not discussing a potential oil output increase. Manisha Gupta is standing by with a wrap of all the action that we've seen in the oil market.
Well, yes, the last 24 hours have been very volatile for the crude oil prices, which actually seems to be becoming its behavioral pattern by now. But a 5% decline after the WSJ report suggesting that OPEC and allies could be increasing production even as the prices are declining did lead to a very sharp cut in the crude prices. 5% down at one point in time, but not only did we see all of that recover, but the crude prices overnight closed 0.5% on the higher side, and the day-to-day has seen some consolidation come in for the prices. If you look at the last 15 days itself, the crude price range has been $98 on the higher side and $82 on the lower side. And the markets do say that the volatility will just about continue going forward in the next 1 month as well. To begin with, it has been about a bit of a strength in US dollar. The Chinese COVID cases continue to surge and the demand is expected to be on the weaker side. Europe has enough supplies, inventories as of now to tackle their winter demand. And then the US economic data, most of that continues to be on the weaker side, is all weighing on crude. And then to look forward is the OPEC and allies meeting, which is happening on 4th of December, where they will review the production policy. And the next day, which is 5th of December, is when the European Union and G7 are looking to impose a price cap on all of Russian crude export. How does Russia react to that is something that would move the crude prices going forward. And then as you move ahead on 14th of December, you have the US Fed policy as well. So the first half of December does promise to be very volatile, choppy, and is how the markets will look like before they head into holiday season there. The expectation also, when you look at the range for the crude prices, is that even with all of this happening, we have been able to hold around that $90 per barrel mark. So a lower side is perhaps 88 when it comes to the Brent crude prices. The higher side is still capped at around $98 to $100 a barrel.
Thank you very much, Manisha, for that. Now let's move on to the news on SEBI. The market regulator has formed a committee to review benchmarking of schemes across categories, including equity, fixed income, and others. Sources have told CNBC TV18 the committee is likely to summon recommendations by early next year. Pavitra is standing by with the details. Pavitra?
Thanks a lot for that. We learned from sources that the SEBI has formed a committee to look into reviewing the benchmarking of mutual fund schemes. So this is going to be across categories. The committee is discussing, the benchmarking revision across categories, so across equities, fixed income, actively and passively managed funds as well. And the committee is also likely to sort of evaluate what the stock and sector caps should be. Of course, just to alert our viewers, for now, the sector cap is at 25%. That's the max holding that you can have. And for a stock, it is 10%. So they are going to be talking about that as well. The committee is also looking at sort of the suitability of benchmarks for alpha generation. We have been talking to a bunch of fund managers. And what they have to say is that ultimately their performance is going to be evaluated and the kind of returns that they can generate. So maybe they should have a little bit more flexibility and they should be allowed a slightly higher allocation for sectors and stocks. We learned that one meeting of the committee has already happened and a decision on this front could be out, in a couple of months. So maybe early next year is when we're looking at a decision on this.
Pavitra, thank you very much for those details. Need to slip into a break, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're watching Markets Today on CNBC-TV18, and let's run our viewers through the rest of the headlines that we're tracking. The fourth headline is GAIL and GSPL. Both of them gained close to about 2% after the revised gas pipeline tariff norms came into effect. Sonal is here standing by to tell us what changed and what are the implications for these pipeline operator companies. Sonal?
Thanks a lot for that. Well, yes, these pipeline tariffs, it's positive for the likes of GAIL and GSPL, which are the operators of gas pipelines in the country. To tell you what the news is, PNGRB has notified these natural gas pipeline tariff, and this is applicable with effect from 18 November 2022. While there are a lot of changes, I'm just highlighting the important ones here. The first is that there is discontinuation of proposal to share 50% of the proposed incremental tariff revenues, and because of this, earlier, these pipelines were not going ahead with expansion plans, but now that they don't have to share this revenue, MK says that this is positive for brownfield network capacity expansion. The second one is that transmission loss is now being considered versus earlier, where there's no provision to consider any gas which was lost in transmission, and MK says this would be positive for GSPL to the tune of 3% on its tariff, and they could account for losses right now in their PNL as well. There is a gradual annual escalation in tariff which is allowed now. Earlier it would happen with a break of around 3 to 4 years. There would be a lump sum hike in tariffs, but now it has been recommended that it will happen every year basis some formula. MK says that PNGRB wants entities to earn a reasonable rate of return, and their channel checks indicate that yes, pipeline operators are actually happy with the changes that have been announced. This will pave way for future expansion in the pipeline infrastructure. Unified tariff is also likely to be implemented from 1st April 2023, which is another positive for the likes of GAIL and GSPL. Citi says that new pipeline tariffs have positive implications for tariffs of GSPL and GAIL. Tariff policy favors GSPL more because that has been an overhang for the company. Introduction of integrated tariffs is positive for GAIL. GAIL, however, faces some earnings headwinds in the other three businesses which are commoditized, the marketing, LPG and petchem business. On the back of this, they have upgraded GAIL to a neutral from a sell, target raised to 90 rupees per share. However, they maintain their buy rating on GSPL with a target price of 335 rupees per share.
Sonal, thank you very much for those details. The fifth headline for the day, Dr. Reddy's has been named as a defendant in an antitrust complaint filed in the US court. The complaint alleges that these companies restrain competition and maintain monopoly. Despite this, you actually saw the stock end in the green with a gain of close to about 0.3%, possibly because this was already factored in as a possible litigation when Natco was sued for Revlimid generic, the cancer drug. Ekta standing by with the details. Ekta.
Well, yes, the news is on another litigation with regards to the blockbuster cancer drug Revlimid generic, which went off patent earlier this year. Just to put the news into context, Natco as well as a bunch of other pharma companies such as Dr. Reddy's, Cipla had settled with the innovator Bristol Myers Squibb and Celgene to launch the generic version in March of 2022. In a staggered manner through the year and sell only limited volumes up till Jan of 2026. Now, earlier this month already, we did see the likes of pharma distributor Walgreens file an antitrust lawsuit against Natco with its partner Teva, which were the first companies to launch the generic version in March of 2022 with exclusivity, along with Bristol Myers Squibb on this particular anti-competitive nature which Walgreens is basically litigating against. Now, at that point, Dr. Reddy's had corrected significantly because the street was assuming that Dr. Reddy's, along with the other generic companies, could also possibly see litigations going forward. And that's particularly the news that has happened. There is a fresh litigation against Dr. Reddy's, along with innovator Celgene and BMS and other generic companies, which have been named defendants in a complaint filed on November 18th. The complaint is on behalf of indirect purchasers, and they are seeking damages. The main point of contention in this particular agreement is basically the agreement with BMS and the generic companies improperly delayed generic competition until 2022 and limited competition until 2026. Remember that Dr. Reddy's had launched all of the versions of this particular Revlimid generic in September 2022, and they had exclusivity on 2 strengths. So the street is now going to watch what the litigation outcome could be. There could be possible settlements which could take place, which could be a monetary compensation, and hence the street has probably factored it in simply when NATCO had already released a statement indicating that they were one of the first to in fact be litigated against when it came to Revlimid generic.
Ekta, thank you very much for all those details. Moving on, Kaynes Technology has made a strong debut on the bourses today. The company listed at a premium of 32% and finally closed with gains of 18%. We had a chat with the management earlier today. They said that medical electronics is a focus area for the company as it is a margin accretive business. Well, with that, it's a wrap on this edition of Markets Today. Thank you for watching.